Very good evening, everyone, and a very warm welcome to all. And thank you all for taking time to join us for today's webinar. Right, so we're still waiting for a few more of our participants to stream in, and those who are already in today's session, please do use the chat function to say hi. Don't be a stranger. Right, make yourselves comfortable. For those of us who have not actually gotten your dinner, please do grab something to eat while listening in for today's webinar. Well, this is the advantage of having a webinar session, and I'm sure pretty much most of us are working from home these days, right? So together with me today, I have some colleagues from the advisory team and the ops team as well. So they'll be on hand to assist if you have any technical issues or if you have any questions regarding the content that I will be sharing tonight. All right. So hello, hi everyone. Hi Xiaofei. Hi Peter. Hi Amos. Hi Tanzin. Yeah. Don't be a stranger. Say hi. Hi Isaac. Thanks for coming. All right, so once again, while we're waiting for the rest to stream in order to honor those of you who are punctual, right? I think we should go ahead and start. The time now is 7:01. All right, so once again, good evening to everyone. Hey, hi Richard, hi, thank you. All right, once again, good evening to everyone. My name is Albert and I am with the Solutions and Financial Literacy team at Money Owl. And my job is to help people understand financial planning better, and also to help guide them take action towards their own financial planning. And for today, for tonight especially, I'm going to be covering on one such topic, which has gained some traction recently, especially amongst the industry people. Right, and we have also lined up a series of webinars. We call it the Demystifying Insurance webinar series, right, starting from tonight. And we all know that insurance is not exactly a simple or a straightforward topic, right? And hence we have broken it down into a few areas to dive in and explore over the next few webinars. So do keep in touch, or rather do keep a lookout, right, for our next three upcoming webinars on different areas of insurance. So to start us off, let us explore what participating policies are, right, and their role in our financial plans. All right, give me a moment. Yep. Okay, right. So for those who are new to us, right, just allow me to introduce who we are at Money Owl. Right, so Money Owl, we are a financial advisor and also a fund management company licensed by the MAS. We are a joint venture between NTUC Enterprise and Provident Limited, Singapore's first fee-only financial advisor. Now, Provident and NTUC, they both have many decades of doing right and doing good. And at Money Owl, we continue to build on this heritage, right? And to help people like yourself today, to help them make wise money decisions easily and confidently. Now, by engaging in our comprehensive financial planning service, you will get a competent advisor, competent in the sense they are at least an AWP, or what we call the Associate Wealth Planner accredited, who is also conflict-free. Now, what do we mean by that? As our advisors are fully salaried and they do not take commissions, and we are augmented by technology in a lot of our processes, and that is what makes Money Owl Singapore's first bionic financial advisor. And a warm welcome to those who are new to us at Money Owl. Today we have a mixture of our existing clients, and also some of us who could be the first time hearing about us today, right? So what are we going to be covering today? A quick run through the agenda, right? So most importantly, right, we want to answer this question: what is participating insurance policy, in short, PAR policies, right? And as a follow-up to that, right, what is the role of insurance in our financial plan? And how about the role specifically of PAR policies in our financial plan, right? And I'm also going to be spending some time to talk about what are some of the upcoming changes in the industry to PAR plans and how will it affect us, especially for those of us who have some policies under our name, right? And we are worried, right, due to this COVID crisis and what there have been news events. So we'll be going through step by step over tonight's webinar. And perhaps a good way for me to bring us through today's topic would be to share a story of a typical hardworking Singaporean, like Singaporean man, like many of us here today, right? Very hardworking, even at this hour. Somebody, all right. Yeah, so I would like all of us to meet my friend Greg. Greg, he is a few years older than me, and he's happily married with 2 children. A boy is 11 years old, and he has a younger daughter who is 8 years old. Now, Greg works as a project manager in a large MNC, a multinational company. So we know that multinational companies, very big companies, they usually have pretty good employee benefits in terms of the insurance coverage that he gets. So in a way, his own insurance planning has always taken the back seat as a result. But fortunately or unfortunately, last year, during the midst of the COVID-19 crisis, right, and in the midst of the circuit breaker, like many of us, he was also working from home for a few months. And in that period, he realized that it was tough, but he also got the opportunity to spend more time with his children. It suddenly dawned upon him that what if he succumbed to the virus during that period, right? More importantly, what if he was retrenched and he lost all of his employee benefits? And he was thinking to himself, right, are his 2 kids going to be well taken care of? Is the burden going to then fall to the shoulders of his spouse? Right? So let's take a look at Greg's insurance makeup. Yeah, he has a total of 7 insurance policies, like we see on the screen now. He has 1 whole life plan. He has 2 endowments for his children's education needs. Right? He also has 3 shield plans with riders. So his own and his 2 children, he's paying for them. He's also upgraded his CareShield Life with a supplement plan using his MediSave. Now, in all, he is paying a total of about $19,400 per year for premiums. Now that represents about 20% of his annual income, and pretty much his insurance portfolio is quite representative of the typical Singaporean, which I'll share more in the next slide. Right. So at this point, maybe I'll just highlight, right, which are the participating policies in Greg's insurance portfolio, right? So of course, the first one would be his whole life plan, right? That would be a form of a participating policy. His endowment policies are also a form of participating policies as well. Okay, now let's move on to take a deep dive into his insurance. And basically, like I mentioned, is very typical of a typical, or rather representative of a typical Singaporean. And why do I say that, right? Let me just bring out the first row, right? This is the part whereby we call it the mortality needs, right? In other words, today, if Greg were to pass away, right, his family would need this amount, right? $1.2 million. That's what we arrived at. But he only has a 1 whole life plan which covers him for 400,000. Now, at this point, I just want to share where did I get this, or rather, this representative of a typical Singaporean from, right? So basically, I was referring to the life insurance industry, or the LIA's 2017 the Protection Gap Study report. And they basically found that there are protection gaps for economically active Singaporeans and PRs. From a similar study done in 2011, there was an increase in the protection gap, right? And the average, they found that the average mortality protection gap was about 2.1 times of the annual income average, right? And for critical illness, the gap was slightly more at 3.1 times of the average annual income. Now, I believe that this is largely due to a better standard of living, and also as a result, we have more liabilities, increased liabilities. Right? So in other words, that means to say the average Singaporean has about 2 years of annual income gap in terms of their mortality needs. So let's look at Greg's current situation. Now, what makes up this 1.2 million? Okay, very quickly, I'll just explain that this amount basically is the amount that it's made up of the amount that he's currently providing for his family, including his 2 children's education needs until the day he retires, or when his dependents become fully independent of him. For example, when his children start working and earning an income to support themselves, right? So in other words, this $1.2 million will see his children through university and ensure that his family will be well taken care of in his absence. Now, he currently has $400,000 of a whole life plan, which he has to pay about $5,600 per year premium, and is required to pay for 25 years. Now, for the ease of reading, I have rounded the premiums to the nearest $10 or $100, right? And just a point to note, right? If you hold on to a whole life plan, which was bought many years ago, right? Back in the day, the older whole life plans, they actually required the policy holders to pay for whole life, right? There wasn't this option of a limited payment. So his was slightly newer, right? He opted for a 25-year payment, right? And now let's move on to the next part, which is on major illnesses, right? His critical illness coverage. Now, at Money Hour, we recommend that the critical illness coverage that one should get is about 4 times of your annual income. Now, why, you may ask, 4 times? Now, statistically, the majority of cancer survivors, they take about 4 years to go into remission, or in other words, have no other signs and symptoms, and so-called, recover. But we in cancer language, there's really isn't a recovery. So you go into remission, right? So statistically, it's about 4 years. And this amount of money represents basically 4 years of income to be paid out in advance should Greg be diagnosed with a major illness. Now, major illnesses, the 3 most common, we are talking about your cancer, your stroke, and heart attack. Now, these 3 form more than half of critical illness claims in Singapore, right? Now, he can then take this money to continue providing for his family without having to worry about a loss of income in the process of him seeking regular treatment. Now, I also want to bring out a point that this money can also be used for some ancillary medical expenses which are not covered by the hospitalization or the Shield plan. Yeah, so we can see that there is still a slight gap, 200,000 of critical illness. And the premium over here, basically, it's a portion of what he is paying within the whole life plan. Yeah. Now, on the topic of hospitalization, right? Hospitalization basically helps us take care of most of the healthcare expenses that are incurred within a hospitalization stay, but there are some that will not be, and we will be talking about that further in detail a little bit later on, right? So Greg realized the importance of having health insurance in Singapore, especially if we are talking about private medical care, right? And so he has actually gotten integrated Shield plans and riders for himself and his 2 children, right? So a point to note on Shield plan coverage, right? So they cover most major illness treatments such as your chemotherapy, radiotherapy, and the likes of. But I was just highlighted this point that they do not cover for the consultation fees, right? Because you still need to go to the doctor for your follow-up treatments and all that. Of course, there is the topic of your post-hospitalization and the pre-hospitalization. Now, that is the topic for another day. But by and large, right, we just need to know your Shield plan needs to be complemented with a critical illness plan, right? So they are complementary to each other. Okay, and continuing on his health insurance, Greg has gotten a CareShield Life supplement plan, and he likes the fact that he can actually use his MediSave to pay for this supplement plan and the main plan itself, and he only needs to pay until he is 67 years old. Okay, and that's all for his protection needs. lastly, he has 2 endowment policies that he bought when his 2 children were 3 years old. So each of these endowment policies, he saves about $6,000 per year. Okay, and the projected maturity value of each endowment is about 115,000. Now there is a slight shortfall from the amount that actually we calculated for Greg. Yeah, screen is not full. Oh, okay. Let me know if this is not full screen. Is everyone else seeing the screen all right? Let me just do a quick re-sharing. Yeah. Okay, thank you. Thank you guys. Yeah. So back to this. Yeah. So yeah, there is a slight shortfall, but Greg is pretty confident with his other investments. He's able to make up this slight shortfall. All right. Okay. Thank you everyone for your feedback. Okay. So this is largely the makeup, and we will be revisiting this together. Do take note that Greg has a shortfall in his life protection needs. He has also got a shortfall in his critical illness needs, but he's already pretty maxed out, right, at about 20% of his annual income. Now, we need to ask ourselves a few questions looking at the makeup of Greg's insurance, right? So what is the role of insurance in Greg's personal life, in his financial plan, and in his life plan, right? Is he sufficiently covered with all of his insurance? The answer is no. Yeah. The next question to ask is really, is he overpaying the premiums? And of course, we also need to look at, is there a better way for us to structure his insurance cover? So we're going to answer these questions together, not academically. So I'm not going to ask all of us to answer these questions, but we're going to use the case study as an example for many of the components within participating plans that I'm going to be talking about today. Now, let me just share with us this definition of participating policies. And this is taken from MoneySense, right? MAS, okay? And I've highlighted the words par fund, I've highlighted guaranteed, and also non-guaranteed. And these are the 3 components that I will be specifically diving into within participating policies for tonight's webinar. And what are some examples of participating policies, right? So today, if you own a whole life plan, that is the classic example of a participating policy. If you own an endowment policy, in other words, they are sometimes also called the savings plans, right? Savings insurance plans. Those are also a type of participating policies. Retirement income plans, sometimes also known as annuities, right? So it's really just a very slight difference in the definitions. Annuities, they typically pay an income for life. Retirement income plans for a limited period, right? So these are the 3 types of participating policies that one can have in Singapore. And perhaps the next question to ask is, why do we call it participating, right? And how does the policy holder participate with these policies? So we need to understand, regardless the type of insurance that you hold, you will be receiving benefits in some form, right? So let me break it down into the different components for participating and non-participating policies, all right? For participating policies, you will receive as part of your total benefits, right? Number 1, a guaranteed portion. And number 2, there is a non-guaranteed portion. Now, what makes up this non-guaranteed portion? Number 1, you have your reversionary bonuses, which are declared yearly, and terminal bonuses, which are only paid at the end of the policy term or in the event of a claim, right? So in the event of a claim, this is what you will be getting. The amount that you bought, the sum assured, right? So this is the the amount that you bought for your insurance. Because you are participating, you actually get accumulated reversionary bonuses. Now, a point to note on reversionary bonuses is that every time a reversionary bonus, every year they declare the reversionary bonus. Once it's declared, it's actually guaranteed into the cash values of your policy, right? And upon a claim event, a terminal bonus will also be paid out, okay? Now, second scenario, upon a surrender, now if you decide that this participating policy is no longer relevant in your insurance portfolio, you can surrender the policy, and what will you get back is actually a surrender value. And the surrender value actually makes up the accumulated reversionary bonuses, which you have accumulated through the years. Then how about someone who is holding on to a non-participating policy? Very simple. In the event of a surrender, you will only get back the sum assured, right? In the event of I beg your pardon. In the event of a claim, you will get back the sum assured in the non-par policy. In the event of a surrender, you will get back nothing, right? So an example of non-par policy, very simple, would be your term policies, right? Now, let's say if you hold on to a non-par policy, this is the situation, right? And hence it's called non-participating. Now, remember my friend Greg, right? So Greg got a call from his insurance agent for a review. And the agent also has some updates for him as well. Excuse me, right? So they met up and they did a review of Greg's current financial situation, and they found that his current financial situation has actually changed. Why? Because his income was higher than before, and he also recently acquired a second property. Now, Greg was presented with the findings that he was short of $800,000 coverage, right? So we saw in the table earlier. And his agent quickly calculated the premiums required to reach this $800,000 shortfall. But the premium actually turned out to be way too expensive. Now, does anyone want to make a guess how much was the premium that was quoted to Greg? Type it in the chat. While I take a drink to clear my throat. How much would it cost to breach the $800,000 shortfall? Siu King, 100,000. Wow, that is way too much. Okay, that's a very good guess. 12,000 per year. Yeah, that's a very good guess. You're close. Kenneth. Maybe you are. Wow, GL, 10,000. That is almost exactly. Have you seen my slide? Hui Fong, 24,000, a little bit expensive. Alan, very good guess as well. Yeah, so it turned out to be $10,305, right? $10,305. And of course, Greg asked the question, right? How come so expensive? The agent then asked, right? Well, with this premium that you pay, you actually get three things for the price of one. Let me explain what these three things are, right? Number one, you get insurance cover. So if something happens to you, touch wood, right? Your family will be taken care of with this $800,000 payout. Number two, if nothing happens to you, right, you will be able to get back some money in the form of cash values in the policy, or in a situation whereby if your children are fully grown and independent, right, they started working, you have no more need for this insurance, you can consider even to surrender the policy. Good question, Eileen, how much of the 10,000 can you get back? Later on, I'll have this example. Right, consider surrendering the policy and to supplement his retirement fund. And what is the third thing that could come with paying this $10,000 per year? He can leave a legacy. Let's assume that he doesn't need this money, right? He doesn't need this $800,000, or rather the cash value. Nothing happens to him. He can continue to let the money in the policy compound to the end of his life and leave a legacy for his children and his grandchildren. So in reality, the policy isn't really that expensive in a sense, right? So Casey, you asked, right, what is the main factors when insurers consider determining the quantum of the terminal value in a particular year? There's a few factors that they need to look at, right? Okay. Yeah, correct. There's a few factors that they need to look at. Perhaps my colleagues can help with the answer as I continue, right, with the presentation, right? So at this point, I think some of us, we have already realized that why hasn't him been recommended a term life policy, right? For term life policy, for those of us who own a term life policy, you realize that actually the premiums are a mere fraction of the 10,300 that was quoted to Greg, right? But a term life policy is non-participative, right? And that means that when Greg surrenders the policy, he has no cash values, right? The only way to get something back is when he claims for the policy. Now we'll revisit this story together, and I just want to ask this question, right? Is that really the case? Well, his agent isn't really lying to him, but we need to explore the side of the story that is more seldom discussed. And perhaps for some of us, this could be the first time we are looking at this, right? How is your premium actually allocated, right? It is important for us to understand what happens to the premium that we pay to the insurers. For every $1 that we pay to the insurers, right, this is how it is split. Some of it goes into buying and paying for the insurance cost, right? And most of it goes into investments into participating fund of the insurance company. Yeah, the actual split between this mortality and the investments depends on the insurer, depends on the product, and also the age of the life assured. Now I have a few questions, right? From Desmond, right? You said for par upon surrender, do you usually get close to the guaranteed surrender value? Good question, right? We will have the actual example later on that I will share with you, right, Desmond? Cheng Li, you asked for par policy, is it recommended for policyholder to withdraw the guaranteed slash bonus or maintain the accumulated value and wait for maturity? Now, this question is a little bit technical, right? It really depends on whether or not you're talking about whole life policy or a endowment policy. Of course, for endowments, once you clear the maturity, right, later on I'll have an example to show as well that you will definitely be getting back more than what you put in, but anytime before maturity, it's very dangerous to do so. Even you asked, right, how is this different from, I believe you are referring to ILP. IPL is the procedure that the ladies go for, yeah? All right, the ILP, investment linked policies, right? Yeah, so investment linked policies, the makeup is almost the same, similar. It's just that this investments in the participating fund is into a unit trust that you choose. And that unit trust is actually offered by the insurance companies, all right? Cheng Li, I will come to that, right? We have the actual examples. I knew these questions will come up, right? So we will be going through actual numbers to see, you know, what are the considerations, surrendering, and, you know, what should we hold on to the value and all that, right? So allow me to quickly move on, right? There's another name for these insurance charges. They are also called mortality charges, right? So you never get back your mortality charge, right? This is the cost that you pay for the insurance. Insurance is not free, right? But the additional return that you are getting from a participating plan is because you are given the insurance company the 80 cents extra to invest, right? The key is that you really do not get back the whole of the $1, or rather the whole $1 doesn't get invested. Now, I wish I can really go in and dive deep, but we have a whole lot more of content to cover today, right? So at this point, I just want to share with us, we actually have a whole ebook that we have written on whole life versus term life, and basically we go in to talk about what are some of the considerations between these two, right? The argument, which one is better, and you know, what are the considerations for both. But actually, back to today's topic, right? For those of you who didn't get to scan this or have some issues, don't worry, right? I'll be sharing, or my colleagues can help to share the link in the chat box later on, right? So back to today's topic of par policies, I would just like to get a sensing from the audience today. How many of us we own a participating plan? Please hit Y on the chat. How many of us we do not own any participating plans? Please hit N on the chat. Okay, yes. Wow, a lot of yeses. A few no's I saw. Thank you all for your responses. It feels that I am really speaking to a live crowd today. No, term plans all the way. Okay, Jeffrey, thanks for that. Both, yes. Yeah, most people would have both, right? Okay, yes. All right. Thank you all for your responses. Desmond, you brought up a very, very good movement, right? That has been going around for some time, right? Buy term, invest the rest. We will be talking about that further later on today. Wilson, term plan, free your cash, invest and grow the wealth. Okay, hold on to your horses, right? I know a lot of us are very interested, very excited when we talk about buy term, invest the rest, but I want to share with us that it really isn't because we want to buy term, invest the rest. Okay, but okay, those of you who are keen, read this ebook. Really very very good information in there, right? For those of us who have owned a participating policy, now this shouldn't come as a surprise to you, right? This is basically taken from one of Greg's endowment policies for his younger daughter, right? So he bought this policy when she was 3 years old and it will mature in 15 years, right? So you see the end of the policy, 15 years, okay? And basically you will see, as always in the participating policy, especially in endowment, right? There will always be two lines of projections, okay? The first will be your 3.25%. The second line of projection will be 4.75%, okay? Then there is also a column which will show you the guaranteed returns. And there is also the columns for the non-guaranteed returns as well. And this is the part which I think most of us, we usually misunderstand, right? And I want to share this with all of us today. So once and for all, we can make a better informed decision when it comes to looking at the maturity values when we are evaluating the endowment policies. Let's run these numbers through Excel and see what the IRR is. For those of us who are a little bit more savvy, IRR, we already know what it means. For those of us who don't know what I'm talking about, IRR simply stands for the internal rates of return. It is simply a measure of the profitability of investments. Okay, now, I just want all of us to make a guess, right? Based on these numbers, what is the guaranteed IRR to the policy holder? Based on these numbers, what is the actual return that the policy holder is getting? Yes, in terms of IRR percentage, yes, 96,000. But okay, Richard, 2%, 1.5. Daniel Chin, 103% is a wrong way to calculate. Okay. Okay, Dom, 0.5 close. Okay. Chung Wei, 0.4 close. Yes, Samuel, less than 1%. Wow, very exact. Wei Shun, 0.44. Okay, don't know. Come, let me tell everyone. 0.8%. Okay. You can do this on your own. Just run the calculations through Excel. You can speak to our advisors. They'll be happy to help you do the evaluations as well. But really, if you're talking about the absolute return on the policy, it's actually only 0.8%. Okay. Now, how about the projected illustration return at 3.25? What is the IRR? Anyone wants to make a guess? It definitely will be higher than 0.8. Okay, 1.1, 1.5. Xinhua says 2.5%, 1.5%. Good guesses, good guesses. Okay. Fei Lan, you can speak to our advisors. We will be happy to show you how we do the calculations. Yeah, most people will not know how to calculate, and that's why we want to speak to our financial advisors to help us do this as well. 0.8% for 15 years, right? 15 years. Okay, now, what is the projected IRR for the 3.25, 1.5%? Okay, and I don't want to keep all of us waiting, right? How about the 4.75? I don't want to burst your bubble. It's only about 2.9%, right? 15 years. I might as well throw it into SSB. Okay, yeah. So really, we're looking at 4.75% projection. The IRR is really only 2.9%. Wow, great point. We have a CPF supporter today in the audience, Tan ZH, right? CPF is better. Yes, absolutely correct. But CPF, very limited usage, right? I will talk about it in a later. Yeah, correct. Right. But really, in terms of returns wise, Why is it that they are still putting 3.25, 4.75? Very simple. This is regulation by Life Insurance Association, Life Insurance Association guidelines. Okay. Good point, Eileen. You brought out CPFSA. You put in money, you actually reduce taxes, right? But the question we want to ask, right, back to today's topic is, why is it that the actual returns are so much lower than the 3.25 and the 4.75%? Now, why is it that the policyholder does not get the full illustrated 4.75% return on the premium? Yes, good point, Tan Zhe, right? Your Zoom name is a bit of a mouthful, Tan Zhe. Okay. Richard, yes, good point, right? Commissions. The first one, we recall the pie chart that I shared just now, right? Not everything is invested, not the full premium is being invested. So already there is some cost there, the insurance cost. Yes, good point, GL. Insurance, you have distribution costs as well. But perhaps I also want to highlight that there is this 90-10 rule, right? Because there are shareholders that participate in insurance companies, right? For every 10% of return that shareholders they take, 90% has to be paid out to policyholders in terms of the bonuses, right? So this is also another layer of cost in terms of cost sharing, or rather bonus sharing with the shareholders as well. Another reason is that the reserves is to help support the solvency of the participating fund itself. And for the same reason, there is this concept of bonus smoothing, right? For those of us who are aware, right, it doesn't mean that in 1 year you get an exceptional return. You will get the full payouts in terms of bonuses. And for that reason, you will never see that insurance companies will pay more than illustrated return in 1 year, right? And as pointed out by shareholders shareholders of the insurance company, right? Shareholders, so you buy the stock of the insurance company, you'll get a dividend payout, right? So that's where you actually share the performance of the insurance company as well. Okay, and like one of you mentioned, expenses in terms of the commissions paid to the agents, the advisors, investment costs within the funds, management expense. So we can see that there are many layers of cost involved. Then perhaps the next question that we want to ask ourselves is that, does an insurance does an insurance company always pay the bonuses as per the illustrated return? Now we have to first accept the fact that with the 4.75%, right, you may be only getting about 2.9% IRR, okay? And insurers will always try to pay these bonuses up to the 2.9% IRR. Why? Why is that the case? Now, very simple. The insurer's reputation is at stake, right? And there is also competition from other insurance companies as well. Today, we don't have a monopoly situation whereby you only have one insurance company in Singapore, right? We have many insurance companies and there is competition. And therefore, this 2.9%, we need to bear in mind that it has already been calculated by the actuaries when they design the policies, and they take into account the returns of the participating fund and also the cost of maintaining this policy. So there's really a very fine line between balancing, between keeping for the future, right, storing for a rainy day, and meeting the current obligations of the policy holders, whatever needs to be paid out. And this is what I mean by bonus supportable rate. It might also interest you that insurers have this, what we call a solvency ratio, that they have to abide for the participating fund to ensure that they are able to meet the longer term ability to pay bonuses, right? As such, the insurance or rather investment returns, if they are poor, then insurance companies may have to cut bonuses, okay? Have insurance companies cut bonuses before? KKBT, NTUC pays only pathetic 1.35. Oh, 1.35, I think is pretty good, right? Looking at the example just now. Has insurance companies cut bonuses before? The answer is a resounding yes, right? Now, I just want to share with us an article from last year from the Business Times. Yeah, Chung Wei just cut, right, on terminal bonus. Yes, Colin, good point. NTUC Income is cooperatives. They operate slightly differently. Okay, I think my colleagues will be happy to share more in detail on that. So, which are these three companies that cut bonuses last year? According to the article, Business Times, AIA, AXA Life, and Tokio Marine. Okay, there is also another cut a few years back in the 2008 global financial crisis, right? And NTUC Income was also one of them. Through their history, they have not cut, but in the past 10 years, since 2016, right, in 2009, 2015, I would say that generally bonus cuts don't happen very often, don't happen frequently. It does take a major event for such things to happen, such as the global financial crisis or the recent COVID pandemic to initiate these events. Now, knowing all these backstory to the PAR fund, right? Perhaps it will be a good time for me to share actually what makes up a participating fund, right? Now, any guesses which insurance company this is? Or rather, which insurance company's PAR fund is this? Okay, Desmond, you say AIA. Xinhua says NTUC. Danielle, Prudential. Jing Hao, you got it correct. Yes, the green company, right? Usually when they do this, they always release in their corporate colors, and green color, yes, exactly right, right? Manulife. Okay, I also have an example from NTUC Income. Okay, I have an example from Tokio Marine as well. These are available from their respective participating fund reports, which they release on a yearly basis. Okay, now we can see that most of the PAR funds are rather conservative, right? The makeup of the PAR funds, most of it, the bulk of it is actually in bonds and or fixed income. Okay, and it is also a very important component because where policyholders get their guaranteed returns from is actually from the bond portion of the PAR funds. Okay. Casey, you have a very good question. We will come to that in the later slides. I will share the actual numbers, right? Okay. So, what are the performance of these PAR funds over a period of time? I do not have the latest numbers for all of the insurance companies, so I'm cutting off at 2019. Over the past 5 years, from 2019, you will see some of the insurance companies, their returns, and this is available from MAS insurers returns. Okay, now the question is, why is it that there are very big swings from year to year, right? You will see that 2017 generally was a very good year for most of the insurance companies' PAR funds, but there was a major dip in 2018, apart from NTUC Income. Now, for those of us who have been investing through 2018, right, it would be some of us may remember towards the end of 2018, equities actually dipped pretty badly, and this is in part due to the US-China trade war, right? So the annualized over 5 years, you can see that most of it returning about 4 to 5%. Okay, now what is the benchmark? The insurance companies, they are free to benchmark against depending on their asset mix, right? So depending on the asset mix, it could affect the performance of their PAR funds from year to year as well. Okay, just for the fun of it, right? My team at Money Hour, we decided to construct this index portfolio of a 30% MSCI World equities and 70% global bond, and we realized that the annualized return in that same period is actually about 5.29%. So in a way, this is our index, right? This is the index performance. And as we can see, if I were to flash back again, right, there is only one insurer out of these 8 that actually did better than the index. And this is also in line with the research. Many research that is out there that actively manage funds, they do not consistently perform or rather outperform the index. But really, this is a topic for another day. Yeah. More importantly, we need to remember that 2.9% IRR from Greg's endowment policy, right? If 2.9% was really all that we wanted, like some of us mentioned, wouldn't it be better just for comparison, right? We can just put it in CPF, or we are better off investing in conservative investment instruments, right? So this is a pretty conservative investment, although this is not investable, right? So perhaps the next part of my presentation, I really need to talk about what is the role of insurance in our financial plan. But just to quickly sum up, okay, just to quickly sum up, what is the nature of PAR policies in Greg's situation? He understands that he participates through these PAR policies, the return of the PAR fund, he will get something back because he has given the insurance company a little bit more of that money to invest in the first place. Greg also needs to understand that he does not receive the full 4.75%, as I've explained earlier, right? Through the headline, he gets a lower than this headline return of 2.9%. But there's one thing that's important, right? For Greg, he can take comfort that these insurance companies, they will always try to honor these bonus expectations, and continuing to receive these bonuses is subject to the overall investment performance of the PAR funds as a whole. Okay, so later on, I will be sharing what are some of the developments, changes that we need to be aware of that is particular to this last point over here. All right, now, what is the role of insurance, particularly PAR policies, in my financial plan? I would like to just share with us very quickly, right? This is our timeline, right? We are all working very hard, earning an income, right, in our accumulating years. At some point in time, we want to retire, we want to achieve our financial independence so that we can continue to withdraw until the day we expire, right? And we all have goals that we want to build up towards. So what is the role of insurance in our financial plans, in our life plans, right? This is our life plan. In the event, should we lose our income either for a very long time or permanently, right? And what could cause our income to stop either for a very long time or permanently? There are 3 life risks that could happen to us, right? Death, a disability, or a medical crisis. Now, if any of these 3 life risks happen to us, we need to look at how do we plan our insurance correctly to mitigate each of these 3 life risks. Yeah? But apart from these 3 life risks, there is also another risk. There is also another risk of insufficient returns, right? Insufficient returns being inflation risk, right? If we were to just keep all our hard-earned money in the bank account, right, we will not be able to get that desired return. Therefore, it is important to talk about investment planning. Now, some of us may have heard this, to keep insurance and investment separate, right? And there is a very good reason for this, because objectives of either are very different to begin with. Okay, so let me break it down into protection and accumulation. If insurance is primarily for protection, let me share with us 3 simple steps for us to buy insurance. Okay, first, we need to look at the duration. How long do we need this insurance cover for? Second, we need to look at amount. We need to know how much insurance we need to buy. Lastly, we need to know what is the type of insurance. Should we be making use of a whole life plan? Should we be making use of a term plan? And so on, right? So this should form the sequence of your thought process when you are looking at insurance planning. Not to worry. The point of us having our client advisors here is to help you understand this a little bit better, right? Now, let's dive in on the protection portion, right? For protection, we largely can classify it under income replacement, right? So if the objective of insurance is to replace my income in the event of a death or a disability, this need, how long do I need? I actually really only need it until the day I no longer have an income, right? Or when I no longer have any financial dependence. Now, this is either of which comes later. Now, for example, if you have financial dependents who are dependent on you after your planned retirement, then you better have an insurance coverage that will cover until such a time. Now, if for most of us, our retirement is after our financial dependents become independent of us, then we will only need this cover until our planned retirement. Because I'm sure all of you will agree with me that if we want to buy insurance to replace my income, after I retire, I have no more income to replace, right? So that is why this is a temporary need. Now then the second question is, how much do I need? This will depend on your needs, right? On your income. And what are some of the insurances that we can look at? Term insurance, we can use a disability income insurance, which is also a form of term insurance as well. How about for a major illness, right? For major illness, there are two potential impacts, right? The first is you have medical expenses. The second is that you have a loss of income. Now let's talk about loss of income first, right? Loss of income, same thing, right? When you have no more income to protect, you don't need this protection anymore. Like I mentioned just now, we recommend about 4 years of your annual income. We recommend that you make use of term insurance, critical illness insurance to take care of this need. How about medical expenses in a major illness? Now, medical expenses, you will need to have a very good hospitalization plan, and this plan will need to cover you forever. Right? This is a permanent need for as long as you live, because we do not know when we are going to need to go to the hospital, right? Now, then how much do you need? This will depend on your healthcare expectation. Very simple case in point today, if you need to have that option of private hospitals, right? Private specialists, then make sure that you get a integrated shield plan that covers for private hospitals and below. Now, today, if you are happy with just subsidized treatment, your class B2 and your class C wards, we actually are sufficiently covered with our MediShield Life. Okay, and moving on, there is one small portion that comes under our medical expenses which cannot be paid with hospitalization plans, and this one we will also need for as long as we live. The ballpark figure I put here, 100,000, but it differs from person to person, right? This one you really need to look at whether or not you have a conviction for alternative medicine. Now, what do I mean by alternative medicine? It's not just restricted to your TCM, your traditional Malay, traditional Indian medicine. It is anything that is not prescribed by the mainstream hospitals, okay? Be it your government hospitals, your private hospitals. So long as you have a conviction for that, please make sure that you have some resources that has been catered for that. You can use a combination of term life, you can use a combination of whole life. Just when you ask a question, right? Typically 65 or 70 years old for critical illness, right? If we follow the rule over here, are you intending to retire at 65 or 70? Or do your dependents become independent of you when you are 65 or 70, right? There's no hard and fast rule, which is the exact age that you should be getting the coverage until. It's really based on your personal situation. Okay, so if I may just highlight this small part over here, most of our protection needs are temporary, but there's one small part that we need a whole life plan to cover. Okay, most of the other needs can be covered by term insurance. And I'm going to come to the next topic, right? If most of our needs are temporary, if I can just make use of term insurance, then what if I help Greg to restructure his policies, right? Remember Greg? Okay, I'll bring up his situation once again. What if we restructure his policies with only term insurance? So I take out his whole life plan. Okay, I'm not suggesting we must do this. Okay, this is just for educational sharing purposes. Yeah, please speak to an advisor before you do any decisions on terminating and all that, right? But just for example, okay, in this case, let's say I told Greg, let's change all of your coverage to $1.2 million, and we cover you until 65. How much premium would he need to pay? He will only need to pay $2,400 for 25 years, right? Because he's 40 years old. And I changed his critical illness to a 400,000 critical illness, okay, on the term life policy as well. How much would that cost? 1,001 within the term life premium itself. No changes to the others. How much would his total premiums be? 16,240. we have managed to save $3,000 and fully cover Greg, right? Isn't that a good situation to be in? Let's revisit this buy term, invest the rest again a little bit later. Let me just finish up on the accumulation part. Yeah. So bear in mind, we managed to fully cover with just term plans, okay? But there is still a missing link, right? This is only assuming that Greg doesn't have a conviction for the alternative medicine, that cash resource that he needs, okay? Should Greg buy term, invest the rest? Now let's look at this situation. Yeah, if today he has a $1.2 million mortality shortfall, he needs to buy $1.2 million. If I were to get him a whole life plan, I need to add in that 400,000 of critical illness. He will need to pay $15,796 per year. If he were to use a term plan that covers until 65. Now, I understand some of you are saying 65 is too young, right? This is just the example. Some of us may have a conviction for a longer coverage. You can always go to a term until 70 years old or anything up to your personal needs, right? But if we follow Greg's situation, right, 1.2 million for death, for 400,000 critical illness, 200,000 or rather $22,400 per year in terms of premium. Now, should he buy term, invest the rest? It's really not because he wants to buy term to invest the rest. The question should be, how many of us can actually afford this premium, right? How many of us can afford this $15,000, almost $16,000 per year? Unless you tell me you're earning, $500,000-$600,000 per year, then no problem, right? Most of us, we earn an income, we have limited resources, right? It's very difficult for us to come up with this amount. Now, let's look at the illustration of the values from the whole life plan, right? So on the first year, if you were to buy the whole life plan, you would pay this amount of premium, right? If you surrender your whole life plan in the first 2 years, you will get nothing back. That means your return on investment, okay, I quote unquote investment, right, is actually 0%, okay? So, or rather, is a negative 100% return on investment. How much is the premium for his term life? He's about 2004, right? So I less off this 2004 from the whole life premium. The amount that he can actually take to invest in a 2% instrument, he will get this after 1 year. If he invests in a 4% instrument, he'll get this after 1 year, and a 6% instrument, this as well. Second year, same thing, no returns, okay? He continues to pay the premium, he continues to invest, okay? These are the numbers accordingly. Now, third year and fourth year, all the way up to the fifth year, we can see the numbers, okay? Anytime that you choose to surrender your whole life plan, it is going to make you a very significant loss, right? It's going to make you a very significant loss. And if you were to invest, then you will be getting significantly more, right? Now, how about at the year 25 mark, right? When he is 65 years old and he intends to start to retire, right? And he wants to make use of this policy as the agent told him, right? You can use this as your supplementary retirement. He has paid a total of $394,900 in terms of premiums. And let's take the best case scenario, right? Under the 4.75, he is getting back about $380,695, which is still lesser than what he has put in, even having held on the policy for 25 years. In fact, the break-even point, okay, quote unquote, the break-even point is actually after the 25th year, okay? So really, when we look at it, we also need to look at if you invested in a very low-risk instrument, 2% per year, right? You would have gotten 400 over 1,000 based on the amount that you put in, okay? So the case of buy term, invest the rest really shouldn't just be looking at whether or not you can get the investment return, but more so whether or not you are able to fully cover yourself, right? That is the more important question, whether or not you are able to afford this premium in the first place, right? Now, let me move on to accumulation, right? And I want to spend some time to talk about this because most of us, I'm sure today in the audience, I have some parents with me. Children's education is always the top of their of our minds, right? And the most natural instrument that comes to mind is the enforced savings, right? Through an endowment policy, a savings plan. But I have shown us that the actual returns actually is far lower than projected. And therefore, we can consider from a whole list of investment instruments, such as direct investments, direct equities, such as your stocks, right? If stocks is too risky, you have ETFs, like what Richard mentioned earlier, right? Some funds, exchange traded funds. You can also invest in unit trust funds. There's a whole lot of them. Invest through Money Owl, right? We have low cost investment strategy, investment instruments as well. Now, as long as the investment instrument is able to meet your need for your children's education, then I would call it a good investment, right? You don't have to go in to discuss, the pros and cons of it. So long as you're able to stay invested, so long as it fits your risk appetite. Now, for retirement income, again, the obvious choice is annuity, right? Retirement income, because these products are designed for their very purpose. Although there are very few true annuities left in the market today, okay, because it's simply not a very lucrative product for insurers to sell. Now, annuities pay income for life. Now, not too long ago, there was actually a mispriced annuity. Now, I'm not sure how many of us was able to hop on the bandwagon that actually returned 11% IRR on the annuity, right? It was selling like hotcakes and subsequently was taken off the shelf. I shall not name companies, right? If you know, feel free to share in the chat, right? So some retirement income products, they have limited payout terms. Now, if possible, we can also consider using our CPF, right? Because this is for retirement anyways, we want to encourage that our clients can consider doing a top-up to the CPF, right? As some of you mentioned, you will also get tax reliefs for your top-ups in CPF as well. In terms of what are the alternative instruments available, you can consider using investment, bearing in mind using a withdrawal rule. Now, the most common today would be the 4% withdrawal rule. A simple Google search, you will be able to get many articles, many YouTube videos, right, talking about 4% withdrawal rule, right? Or you can just look for an income distributing fund or dividend paying stocks, right? This would form good alternative instruments for us. Now, the last part, really, you realize that I have come in this sequence, right? That I left leaving a legacy at the very bottom. Why? Because this is only if you have taken care of all bases in your protection needs and your accumulation needs. Then if you still have a desire to leave a legacy for your children or your grandchildren, we can now explore the use of whole life plans, universal life plans, or term life policies to 99 years old. Now, each of these has its pros and cons. It's best to talk to an advisor, our client advisors, right, before you make a decision. But I just want to stress the importance of the sequence in our financial planning, right? We want to first protect the goose that lays the golden eggs, that is yourself. Then, if we have sufficient resources, then we look to protect the eggs itself. In other words, legacy planning shouldn't be the first thing that comes to mind when we are actually looking at your own insurance portfolio, right? Then you're actually jumping the gun. So likewise, the alternatives in terms of investments, you can use a joint investment account. You can use an investment in a trust, right, to serve the purpose of legacy planning. I really don't have time to go in depth on this. I still have quite a fair bit of information to cover, right? So let me move on. How about using an endowment policy for accumulation? Now, some of you ask this question, right? Should you surrender before the maturity, things like that? Perhaps the consideration we need to ask ourselves, let me give us 4 points of consideration, right? Number one, do we need some form of guarantees? Okay, because like one of you mentioned, I saw in the chat just now, investments do not have guarantees, and that is absolutely right, right? If you need some form of guarantees, no choice, right? This is the only way to go, endowments. Number two, are you able to take the lock-in period, right? 15 years, 20 years, right? What if something happens in between, right? What if you lost your job? You're unable to service the premiums, right? Is the return going to be sufficient? 2.9%, remember? Can you stay invested if today you choose to go for the investment option? Now, same thing, I've done a table to share with us. What if we chose to go for an endowment policy versus we invest in, say, for example, a unit trust instrument, okay? So same thing as the whole life plan. If we surrender in the first year, right, you will get nothing back, okay? Okay, apologies, right? In the first year, you will get nothing back, 100% losses, right? If you have invested this $6,000 in a unit trust, giving a 2% return, you would have gotten 6,120 and so on and so forth, right? Second year, 12,000, this will be the guaranteed values, okay? Non-guaranteed values, 2,002, and this will be the investment values. I'll move on to year 3, to year 4, to year 5, okay? I'll just pause for a while. Let us have a look at these numbers, okay? Specifically on the left side. You realize that the returns on your investments is always going to be a negative return if you are intending to drop out halfway using an endowment policy, right? But remember, Greg's policy is 15 years, right? What if, let's say, there was an emergency that happened on the 14th year, 1 year before the maturity, year 14, he would have put 84,000 into this endowment policy. The guaranteed amount that he gets back is only 79,143, right? For the many reasons that we have mentioned just now, the non-guaranteed surrender value at 3.25 projection is about 81,785. The non-guaranteed surrender value projected at 4.75 is about 90,564, just a 1% ROI, right? And finally, if we were to hold on to 15 years maturity, yes, you will get back the full sum, that you will get more than what you put back, right? And most endowment policies work that way. Looking at the lower end projection, you're getting 101,000. That's about 1.5% IRR. Looking at the higher end projection, 114,121. That's about 2.9%, right? So this is exactly the same policy that I showed just now. Greg's policy that he bought for his daughter, right? Now this, he is happy with it, right? He wants to have the guarantee as well. So he is going to stick to having, or rather to use endowment policies for his 2 children's education needs. But whether or not you should use an endowment policy for your own needs, right? You have to ask the question. Now I highlighted these 2 numbers, right? On the lower end of the projection, you get 101,549 on the endowment policy. Now, let's say if we invest in a very, very low risk instrument, right, for 15 years, you would have gotten 105,000, right? That is still more than what you are getting based on the projected amount. Okay, so then it is really not a very simple yes or no, right? Is this better? Is that better? I would like to just share very quickly how at Money Hour we help our clients do their planning for the retirement portion, right? So same thing, we look at your situation, right? We look at when do you want to retire? When is your desired retirement age? Every one of us has a different number on this, but perhaps we should first build on the guaranteed basis first, right? And which is the most guaranteed of all, CPF Life, right? From age 65, we will get a certain payout depending on how much you put into your CPF, right? Of course, from age 55 onwards, should you have a need that you want to retire earlier, you can also withdraw from your ordinary and special accounts, or you could have already gotten some participating policies, right, in the form of retirement income products, which give a certain level of guarantee as well. Now, depending on the amount, based on current estimates, if you were to fully max out your CPF accounts, if you are 55 today, you are getting about $2,000 per month, right? I've not taken into account the retirement income as well. Right, so about $2,000 for basic living expenses. I want to ask all of us this question, right? Looking at $2,000 per month, is that enough for most of us? I think I don't have to wait for you to say. Most of us would say that $2,000 per month is too low, right? So there we need to look at how do we layer on top of this guaranteed basis to support our lifestyle needs, right? If we want to drive a car and we go for holiday every other year, right? Barring the COVID pandemic, right? We definitely need to have more than $2,000 per month in terms of our retirement income. This is where investments come in. If we are in a privileged position that we are able to buy a second property, we can collect rental. If we hold a decent stock portfolio that pays dividends and so on, right, we will be able to build on top for our lifestyle related expenses. Now, PJ, you asked, is this 2,000 a month from CPF Life only? Yes, this is assuming at 55 years old, you have the enhanced retirement sum. Okay, the enhanced retirement sum. I'm running a little bit short of time today. I wish I had time to talk all about CPF, but perhaps we may be talking about CPF for another webinar, right? CPF Life payout got capped or not? Yes. CPF Life payout, there is a cap, right? So depending on how much you put in, you will get a certain amount, okay? So it will differ from person to person. So I just want to share this matrix with all of us and allow me to change to my annotation tool, right? Okay, so in terms of investments, whatever we have at Money Owl, the solutions include our Wise Income portfolio and our dimensional balanced portfolio. I'm taking the middle portfolio just for a comparison. Yeah. So for the Wise Income, it is basically an investment portfolio that is designed for withdrawals from the ground up. Yeah. For dimensional portfolios, it is designed for accumulations, right? So there isn't focus for payouts, there isn't focus for dividends, right? If you guys are new to this, I would encourage you to actually catch up on our past webinars where we actually talked about our Wise Income Fund and also our dimensional portfolios. And then I'm also going to compare it to a retirement income product with a limited payout term and retirement product with a lifelong payout term. Now we can use this, but feel free to use take a screenshot of this if you want, right? To help you in your decision process, right? And there's really no yes or no right or wrong. Everyone will be different, but let's just go through it together, right? I have some matrix that we can use as a guide, whether or not investments is for us, or I should go to make use of a retirement income product. Number one, guaranteed payouts. Do I need to have that guarantee or not? For the investments, we have established, right, no guarantees. But for our retirement income products, yes, there will be a certain level of guarantee, but very low. Yeah. Is there going to be a higher projected returns on the investment? So we are looking at 6% thereabouts for the Wise Income. For the balanced portfolio, also about 6%. In terms of the absolute returns for the retirement income products, about 3 to 4. Okay, depending on how long your product stretches. Yeah. How about how long you need this payout for? In terms of Wise Income, it is actually going to be perpetual, right? Unless you go for the accumulating portion, right? And perhaps there is a shorter runway. Okay. In terms of dimensional with a 4% withdrawal, we have done our modeling. It takes it's safe to say it can last about 30 years as well. So that's pretty good. In terms of the term payout, usually we cannot find anything that goes beyond 50 years. Okay. For retirement income lifetime payouts, definitely you will be able to get that lifetime payouts. Thanks for the shout out, Colin. Yeah. Okay. Yeah. So whether or not you require a stable and fixed payout, right? For our Wise Income portfolio, this is done at the fund level, right? So you will get this stable payout. Similarly, for the retirement insurance product, in terms of the dimensional portfolio, I will put a tick over here as well because it's really up to you. On years whereby you require more, you can actually take more than 4%, right? You don't have to stick by the stick by the 4% hard and fast. Okay. How about in terms of the absolute cost? We have established the total cost of our retirement income product is about 1 to 3%, pretty expensive. All-in cost, okay, our Wise Income is at about 1.25. Dimensional portfolios is about 0.9%. Do you require a residual value after 30 years? Okay, depending on which payout option for Wise Income, you will have some residual value over here. Dimensional portfolio as well. Usually for the retirement income term payouts, it will finish by then. For the lifetime income payouts, there should be some residual values as well. And finally, do you require that flexibility, right? For investments, anytime you can chop and change, up to you. You can even stop your contributions. You can stop your withdrawals as well, right? But for your retirement income products, really you are fixed to it from the day you sign the policy, right? So if you have signed a lifetime, you are fixed to it for lifetime. Okay, so this is a decision matrix. Okay, like I say, there is really no yes or no. It is really something that we can consider using. And let me just very quickly clear all of my annotations. So for those of you who are keen, I encourage you to just maybe take a screenshot, take a photo of this matrix to help in your decision-making process. All right. Elaine, you have a question. The two green ones, how liquid are these? Very, very liquid, right? As with investments in unit trusts. So both of them, they are unit trust funds. Anytime you choose to withdraw, the amount will be credited back to you, right? The units will be sold off and it will be credited back to you. Okay. Thank you for the question so far, and I'm glad to see that the engagement is still very good. Now, I just want to quickly end off this portion, right? That I want to stress one point. As much as I'm saying, you know, investment is good, this and that, investment may not be suitable for everyone, right? There are some of us that really cannot take the volatility of the markets. Yeah? There are some of us, perhaps we are already approaching our retirement. Maybe I'm already 65 years old, and I really don't have that runway to ride out that volatility. And perhaps investments isn't that good for us, right? If I am not a very avid investor, right, and if I happen to sell off my investments during a downturn, that compounds my losses and my plan will be affected. And if I am someone who doesn't have the discipline to regularly save and invest, a structured retirement income product or endowment plan perhaps would be a better option. Yeah? So really, objective of me sharing all this is to give us the knowledge, but at the end of the day, it is still vital that we sit down with our advisors, sit down with our client advisors, right, to talk through your plan and see which are the instruments that could best meet your needs. Right? Roy Jester, you ask why use UT and not ETFs. Right? We have an article. So if you go onto our website, right, we have an article. If you search UTs and ETFs, right, well written by an ex-colleague of mine, and we explain very clearly why we chose to use a unit trust instead of using ETFs. What do I think of bonds? Liu Sus. What do I think of bonds? For myself, bonds are definitely a good alternative if you require that guarantee, right? However, this brings me to my next topic. Thank you very much, Liu, right? In terms of bond yields dropping, right? The general situation on the bond side of things as well. So let me quickly sum up. For insurance, if we are using it for protection, wow, CH, thank you very much, right? That is exactly the article that I was referring to, right? Feel free to read it. Pay attention first, right? All right, so we advocate the use of term plans for protection, right? Par plans are simply too expensive for protection, as we have seen just now, right? 15,000 versus 2,400. Most needs are temporary, with the exception of alternative medicine, okay, in the case of critical illness. Now, for the case of accumulation, there's no quick answer to this. The returns to par policies are low due to the layers of cost with little flexibility, but it can have a role if you need guarantees if the returns are sufficient to meet your goals and you are able to accept that lock-in period. Okay, so this is a quick summary, and as promised, I'm going to move on very quickly to the last part, right? And what essentially are the upcoming changes to car plans? What is the macro situation, right? So in the next few slides, I will be talking a little bit about this macroeconomic situation and what is its impact on the insurance industry. Now, I just want to put out a quick disclaimer, right? I'm not expert in this, right? Let me quote a CEO of a particular insurance company. He said he's not an expert in this, as well. It's ever changing, right? But let me try and give us the most educated point of view on this, right? Now, since the turn of the century, right, we have seen that bond yields are dropping. Okay, now we do not have to look very far. A quick Google, we take reference from our 10-year SGS, or the Singapore Government Securities. Now, do take note that this SGS is not the SSB bond, not the Singapore Savings Bond. It is the actual Singapore Government Securities. Okay, the 10-year one, the 10-year tranche. So in 2001, this 10-year SGS yield was 4%. Okay, the turn of the century. 2001, 10-year SGS was 4%. It has dropped to less than 1% as of 2020. The last I checked on MAS, it went up to 1.51% yesterday. So yesterday's bond yield for the 10-year SGS was 1.51%. In other words, today, if you were to buy a 10-year Singapore government bond, at the end of 10 years, the total yield would be 1.51%. Okay, so if that is sufficient for you, consider getting yourself a Singapore government security, right? The 10-year SGS. Now, for the benefit of those who are unaware, this 10-year SGS is also the reference for the interest on our CPF Special Medisave and the retirement account, which is currently guaranteed at 4%. But I'm not too sure how long this can last, right? Perhaps now, in the COVID situation, unlikely CPF is going to make any drastic changes, but bear in mind that the CPF Special Medisave retirement interest rates is actually pegged to this 10-year SGS. Okay, so while CPF is holding up fine, insurance companies, they are feeling the impact of this directly in the sense through their participating fund assets, right? So just now we saw in the earlier slides that most of these participating funds, they are heavily invested in bond instruments, right? 60 to 70%. So let's say if the global bond yields are down, it is likely that these insurers, the par fund returns will drop as well, right? It doesn't take an expert for us to see that. So this poses a dilemma to the insurance companies, right? Or rather the managers of the insurance companies' par funds. Should they shift their asset allocation to more risky assets for higher returns, right? This is where the risk-based capital regime comes in. Now, for those of us who are new to this, let me just very quickly share. This risk-based capital regime was implemented into the insurance industry way back in 2004. Okay, and in 31st March 2020, last year, it has been revised to the second version of it. We call it the risk-based capital 2. The gist of it is that the change is now requiring insurance companies to have more capital to whenever they would like to take on a little bit more risk, and also to have more capital to support the guarantees that they promise, right? So for example, today, if an insurance company sells you a 20-year endowment with a guaranteed return of 1%, right, they will have to find a corresponding 20-year bond to back that guarantee that they are giving, right? So that's what I mean by that point over here. And definitely with that lowering or rather the requirement for them to hold that much more capital, it definitely lowers the return on capital for these insurance companies, right? So we have seen in the past few years that insurance companies are slowly moving away from participating fund or rather participating products, right, into non-par products such as your ILPs, right, where the policy holders, you take on the investment risk yourself, and term policies as well. Okay, Now, the net result is that the par fund return is likely to trend downwards, and it's going to affect the ability to sustain these bonus payouts, right? As we have mentioned. And the second consideration is that the future policies, right? From what we know, it will be sometime in the region of about July of this year that the illustrated returns will start to be lowered, right? Not sure how many insurance companies will hop on, but it's a matter of time. So how does this affect Greg? Okay, so back to my friend Greg. For any new policies that he intends to buy, any new par policies, he has to accept that the illustrated rates will be lower. Okay, this means that he has to expect a lower bonus as well. Overall, lower return. How about those insurance policies, the par policies that he bought before the change? The insurers are likely going to hold on, or rather honor these bonus projections for the short term as much as they can. Like I mentioned, reputation is at stake, competition is at stake, right? But over time, in order to maintain the solvency, the sustainability of this par fund, in the long run, they may have to cut. And as we have seen in the examples earlier, the newspaper cuttings that I shared, right? Insurance companies have cut bonuses before, and they are likely going to cut the insurance bonuses. Okay. Now, lastly, let us wrap up by revisiting Greg's insurance policies. All right. What is the date of this change, Kelvin? From what I know, it's July of this year, right? But no fixed date yet. Okay. So keep a lookout. So let's look at the protection needs of Greg, right? So this was his original, right? We looked at it, and he had a shortfall of 800,000, okay. All right. So let's say Greg uses another whole life or par policy to fully cover himself, right? That means to say he will need to buy another $800,000 coverage with a whole life plan. I did the calculation. He needs to spend 10,305, right? Like I mentioned just now, right? He needs to also top up another 200,000 of his critical illness rider, and that will cost another about $700 within his whole life plan as well. So he's paying 19,400 a year now. If he takes this solution, he is going to increase his total annual premiums to 29,705. Astronomical figures, if you were to ask me. Yeah. Is there a better way? Now let's explore second option. Second option would be to use a mixture of par policies, assuming he has a conviction to hold on to this whole life plan. I won't suggest that he terminates it, because why? There is also the consideration of the definition change, right? Recently, last year. Now, this will be a topic that will be covered by my colleague in a subsequent webinar where we talk about critical illness. Okay, and if he were to use a term plan, an $800,000 term plan to 65 will cost him $1,650, and another 200,000 CI rider will cost $600 within that 1,650. His existing was 19,400. Solution 1 would cost him 29,705. Solution 2 will cost him $21,050 a year with a combination of a whole life and term plans, right? So it's not difficult to help us advise, Greg, which is going to be the more sensible option. Okay. Now, Cheris, you asked, right? Does it make sense to surrender whole life policy currently compounded at a return above 4% and buy a universal life policy? This is a very good question, right? Perhaps you might want to speak to one of our client advisors. Okay, there's really no straightforward answer to this. We have to look further into your insurance portfolio as well. Now, Chunfei, you asked, do all par policies across different insurers generally have IRR of 2.9 since they quote? Yes, Chunfei, I think you can say that the ballpark IRR for, depending on the term of the policy as well, is about 2.9 to maybe 3.3%, right? I would say nothing more than 3+%. Across industry is about 3+%. All right. Okay. And lastly, let me talk about the accumulation part of Greg's portfolio, right? So he can choose to keep on to this, right? For his existing endowments, he may still receive the bonuses as per the original illustrations, at the very least in the short term. If he considers surrendering, please speak to an advisor first, right? Because there are costs involved, there are the risk appetite is involved, right? What are the alternatives, right? It's not straightforward yes or no, right? You can consider accumulating for his retirement using CPF, right? You can use retirement income products, but bear in mind that the guarantee may be lower, or you can consider using low-cost, globally diversified instruments such as what we use at Money Owl. Okay, now Eileen, you mentioned guidance is to cover more using term and less using life. Generally, yes, because most of our needs are temporary, but depending on your personal situation, again, I must stress, right? Everyone has a different personal situation, right? There is no straightforward yes or no answer, but generally, most insurance needs can be taken care of with term insurance. Okay, now time now is 8:30 and I have come to the last part where I would just like to quickly summarize all the points that I went through this evening, right? Now, insurance is really a contingency tool in our financial plans. Our main plan is really our financial goals, our life goals, right? Insurance is something that we buy, but we don't want to use. We should therefore view our insurance at premiums as an expense, and on the risk of sounding like a broken record, right? But it's really to buy as much insurance as you need, but to spend as little as possible for your premiums. Okay, this should be the guiding mantra to when we get our insurance for protection. And for protection wise, term insurance is fit for purpose. Participating policies have very specific long-term needs that they fulfill. Okay, now for accumulation-wise, participating policies, they offer some guarantees and lower volatility, but on the flip side, right, the returns and the flexibilities are going to be lower versus our investments as well. And the lower policy illustrations going forward will translate to lower bonuses for par policies expected, right? And yeah, just to sum off, please speak to our advisors, right? If you would like to have a review of your insurance. Okay, Samantha, probably you missed the bit on the why par policies for long-term needs, right? Very specific, specifically in terms of your critical illness. If you have a conviction for alternative medicine, right? So you need this for whole life. Okay. All right. Now, before I leave you, I would just like to thank all of us for holding on throughout the whole 190 of you. Really great. Thanks for all of you for holding throughout this webinar today. And as a thank you to all the participants for today, we have a webinar exclusive, which is that you will enjoy up to 60% commission rebates if you purchase an insurance product with us. Do note that this is a limited time offer, right? So it will last from today till the 18th of next month. Okay, so you can just scan the QR code or you can visit us on our website. Okay, just present the email invite to our client advisors and we'll be happy to do the commission rebate on the back end for you. Okay, thank you all very much. And for those of you who are still around, don't worry, we'll still be around to answer some of your questions. Okay, but in the meantime, let me just ask for your feedback for today's session, whether or not you felt that today's session was good or bad. Okay, do let us know so that we can improve on our future webinar sessions as well. And once again, thank you all very much. And I hope to see you for our next series in our Demystifying Insurance webinar series. Thank you.